Hi, this is Bob Scully, and welcome to another edition of the World Show, Entrepreneurs, the Dobson series. Special program for you today. We've got somebody who knows all about entrepreneurship. He's the chairman of the Dobson Foundation, which tries to further entrepreneurial initiatives. At the same time, he's the president of Formula Growth, a fund that specializes in companies that are entrepreneurial, that are trying to build something. And so he's ideally placed to see how this is unfolding, especially with the mess we're in. So we thought we'd ask Randy Kelly to tell us, because he's out there every day in the battlefield of the markets and finance, trying to fight for entrepreneurs and their companies, and for the investors, for you, for people with 401ks and all their savings tied up in the markets. We thought we'd ask him how this whole system works or doesn't work. Here's Randy Kelly. Randy, through your involvement with the Dobson Foundation, of course, you know about entrepreneurs and entrepreneurship, but you also know them another way through Formula Growth, investing in smaller companies and so on. So I thought you'd be the ideal guy amidst this mess, this nuclear wasteland that we're living in financially, to do with us. I call it finance for dummies, but I suppose I should call it finance for victims, because people are worried about their 401k and they're watching their portfolio shrink and come back and they don't know why. Let's start with this whole thing unfolding. Bear Stearns, Lehman Brothers. Do people in the finance industry, were they genuinely surprised, or did they sort of know and see it coming?
It's, you know, there are those who will say they see things coming, but whenever I talk to people about the market is a very difficult thing to try to manage. And I always think of Mark Twain. He said October was a very tough month to invest in the stock market, but so was November, December, January, February, March, and April. So there are those. Obviously, a market is a bunch of buyers and sellers. So there are some who saw it coming, usually the minority, and there are the others, the majority, who didn't see it coming. It's not very easy to see these sorts of crashes coming. Typically, the crash is often disguised. They're very similar after the fact when one looks back and tries to understand a fraud or a difficulty in a stock market. But the costumes change. I was talking earlier about women. They're at the core. They're the same, but they change with the season and with the fashion. So it's often difficult to see what is going on when it's happening to you, because it's tricky. It's different. The internet bubble was different than the housing bubble. The housing bubble was different than Asian.
Yeah, housing, I can assume, was buried under all kinds of gobbledygook with subprime and certificates and so on. But I'm thinking of things like the leverage allowed on banks and brokerages. Let's talk about, first of all, what is that when they say 30 to 1 and so on? What does that mean?
Well, if you're in the banking business, if you go right back to, say, 50 or 60 years ago, someone like the Bank of America would be required by law to have a certain amount of book value or capital, because they're in the banking business. They're very regulated by the banking authorities in the United States. They're allowed to take that capital, that primary capital they have, and leverage it up by 10 or 12 times.
They lend out more than they take in.
They lend out more than they can take in, and the idea behind that is to protect the depositors who put the money in the bank in the first place, and in order to allow the bank then to lend it out. So a traditional bank in the traditional old days might have lent out 10 to 12 times what they had in value in book value of the bank. Over the years, as we got more sophisticated, and maybe not for the right reasons, banks began to get more aggressive with respect to how much they could lend out. They found other ways to lend out more money. They bought brokers, for example. So the brokerage industry merged with the banking industry. Brokers could find different ways to lend out more money, more times.
But whoever was controlling that, the Fed or the FDIC or whatever, didn't say hold it?
They didn't say hold it at any particular time, because it was deemed to be the acceleration of the velocity of money, just to get money turning quicker, was deemed to be okay. It was deemed to be, if 10 times capital was okay, maybe 15 times is okay. And if you're a broker and you're in the investment banking business, maybe 20 or 30 times is okay. Clearly not is really what happened.
And 1,000 times wouldn't be okay. So
wouldn't
where
be
do you,
okay
where
at
do you draw
all.
the line?
So you draw the line when the line was drawn by Lehman going bankrupt, and it was discovered that Lehman would be levered 40 to 1. Morgan Stanley would be 35 to 1. Bear Stearns was 30 to 1 or 35 to 1.
Which means that when there's a panic, you've only got 1/30th of that in real money.
That's exactly
it. And you're scrambling for the rest, which is all loaned money.
That's it, exactly. It happens to people. It happens. if I have $100 and I borrow $100 and I put $200 in the market, and I've got $200 of stock and the stock goes down 50%, I have just lost all my money because I've lost 50% of the $200.
And they come after you too for the other.
Exactly.
If they come back.
Exactly. Yeah. So if you have 30 times what you actually have in value and you put it in the market, and it's very quick how quickly you can lose your money. It's very quick. You can make a lot of money doing that. If you make a 5% return and you lever it 30 times, you're making a 150% return. So that's.
But everything has to go up.
Everything has to go up.
But isn't this like a speed limit? We could never, no matter what the car accidents are, we could never imagine interstates with a 45-mile-an-hour speed limit. That'll never come back. When the markets bounce back,
right?
The banks and everybody else will ask for that 30 times again, or won't they?
Or it'll probably take a while. Just as a road was not built when it was horses and wagons and you're traveling along at 10 miles an hour, roads got better, you're traveling along at 30 or 40 miles an hour. And in America, we drive along at 60 miles an hour or 65, depending on the state. But in the Autobahns and Germany, you can travel along at 100. So depending on the system, the underlying system, it's natural to assume that things like leverage and tools that investment firms use should accelerate, to use that, to continue with that analogy.
But will they come back to what they were?
Will they come back to will we go back to the, I don't think we're going back to the horse and buggy rates of leverage. We'll probably back off the speedway rates of leverage. So I think there will be a governor put on regulators will probably want to put their foot on the brake a little bit and put a governor on how people behave in my business.